And specifically, I'm going to start here at the top because what everybody wants to know right now, the $1 million question, is around market timing. So here I've got from Ariana, I've got a question about the timing of investing. Who doesn't right now? Is this a good time to start if we are new to investing, or do I believe things are too volatile? If it is a good time, should we start with just a small amount? So really when it comes to this with market timing, again, my caveat that I don't have the crystal ball, I don't know what's going to happen, but what I'm doing right now is asking 3 main questions. Question number 1 is going to be, is your income affected by the crisis? And I would say obviously some people have lost their jobs right away. And in that case, if your income has been affected, if your income is way down, don't. But also you got to be careful right now because what we're starting to see is, again, the dominoes fall. And we're starting to see a lot of companies start to cut back and let go of employees. And it might not necessarily be the companies that you would think. They might not be from an affected sector. But if they were just in bad financial shape before, let's say they borrowed a bunch of money or they raised a bunch of money and now they need to lower their burn rate, or they're a little bit worried, they're a little underwater. A lot of companies that even if you'd think they would be fine and you're able to work from home, I do think we're going to start to have job losses here. So really for me, I would be cautious here and look at not only your personal job and your personal income, but also look at your company, right? Or if you run your own business, look at your customers, and really to think that over the next few months, might they stop investing as much or spending as much? So that's really going to be number 1 is your income. Number 2 is going to be your emergency fund. So do you have debt or an emergency fund? Right? And if people are in debt right now, if you've got a student loan, even if you've got like a big mortgage and these big hefty mortgage payments and all that, mortgage is like an okay debt to have. But certainly if you've got a line of credit or if you have any credit card money balance there, do not invest right now if you have any debt. And then I do want to make sure you have an emergency fund. And whereas I used to talk about having somewhere between like 2 months until 6 months, right? If it was 2 months to 6 months, that would be okay. That now I'm really talking about having 6 months to 12 months. That really I almost want to have you to have a full year of cash set aside to be able to handle any emergencies. So that's going to be the next question, really looking at your cash flow, and in the worst case scenario, if stuff does go down, are you in good shape? Hopefully you don't have debt, you have your emergency fund. And the last case is, the question is really, is it for the long term? That, if you're thinking about buying a house or a condo in the next 3 to 5 years, you should not be investing right now. This is way too volatile. Don't even go near the markets. Really you want, maybe bonds, I would suggest just cash. Again, normally in the past, I would say at least a 3-year horizon, right? Now I'm saying at least a 5-year horizon. Because if the market does crash, it could take 5 years to get back to where it was, right? So if it's less than a 5-year horizon, don't invest right now. But if it's like for retirement and, you're young and you've got decades and decades, then hey, now is a good time to start investing. From there, should we start with just a small amount? So yeah, this is really what I've been suggesting to a lot of clients right now. And especially if it's a nest egg, that if you have like a certain amount of money and that's all the money you have, let's say it's like an inheritance or, you had a savings account and it kind of was like ballooned up. So now you've got like a big chunk of money. You probably don't want to do it all at once. This is where you probably want to use a strategy called dollar cost averaging. I've talked a lot about this in the past couple weeks. This is the idea of splitting it up and sort of doing it in chunks. The analogy I use is that we're throwing darts, but we're blindfolded right now. We don't know what's going to happen. So instead of throwing all of your money in one dart, split it up between 3 darts or 4 darts or 5 darts. You can do, 25% at a time, over the next few months. And what that'll do is reduce your risk of volatility. That if it does go down further, not a big deal. You can throw another dart and buy things when they're lower. That said, a lot of us do dollar cost averaging just by default. like just over time, this is what we do, is really using this approach. We're just going to save, right, every month, and then you're going to invest that every single month. In terms of Denise, would you say stay the course with investments, i.e. keep putting cash into investments, or hold cash right now? So again, this is a really, really tricky question. I'm going to come back to my questions that I wrote at the top. And Denise, like straight up, I know your situation a little bit, and it's like, is your income affected by the crisis? And, it wouldn't surprise me if it did, that, you're seeing less income right now. I don't know that for sure. But if your income is affected by the crisis, and yes, it is, keep cash. Number two is, do you have debt or an emergency fund, right? If you've got debt, keep it in cash. If you don't have an emergency fund, guess what? You need an emergency fund. Keep it in cash. Or if it's not for the long term, if you're thinking that in the next 2 years you might, want to buy a rental property or invest it in your business, or, quit your jobs and go traveling all over the world, right? Hard to imagine that right now, but it could be your plan. That if it's not for retirement, if it is for, just looking at a place to park money for the next few years, then, keep it in cash. Really, only if you check all of these boxes, that your income is unaffected, that you've got your emergency fund fully topped out, and this is really for retirement, for long-term savings. If you've ticked all those boxes, keep investing. It doesn't matter if it goes down, right? You're fine, you're in good shape. You can wait for it to come back. And that in fact, this could be a good time to invest. I don't know. So really it's going to come down to these questions. If you feel good about all of these things, then absolutely what we want to do is keep investing right on schedule, stay the course. But, if your income's affected or you're worried that it might be in the future, again, some of these times these things are a little tricky. We don't know what's going to happen. If you're in debt or you don't have a fully funded emergency fund, keep it in cash. Or if it's for the short term, if it's not for retirement, keep it in cash. Hopefully that answers your question.